I want to start out our panel tonight with, how about if we start out with introductions? You can each introduce yourself, and then we'll move on. Alvin, can we start with you?
Yeah, sure. My name's Alvin. I run a hedge fund platform here in Hong Kong called OP Investment Management. We're part of a larger group called Oriental Patron, and we run both private equity and hedge, but the platform that I'm representing is primarily a hedge. We have about 25 managers on the platform, and about half of them are based locally, and the other half from across the region. So if any of you are interested in becoming, institutional players or running money, then please come give me a call. Yeah, looking forward to it.
Olaf.
Hi, so my name is Olaf Kasten, and I'm a partner in a family office advisory business, Ophir Partners here in Hong Kong. And I used to be head of trading for Asia at BNP Paribas and Macquarie Bank, and afterwards developed a trading psychology program, basically working with traders and helping them understand how their personality affects their decision making in trading.
And should we bother? Go ahead. Daryl.
Okay. There's one difference between me and the rest. I trade my own accounts. I don't trade other people's money. We trade across a variety of instruments. So we trade equities, we trade futures, we trade currencies. And we use different techniques for different markets. So in currencies, we'll be focusing on trades that last typically between 5 and 20 minutes, sometimes up to an hour. So the different sorts of techniques we use in those markets are different to the strategic discussions we were talking about before. So just to give you some background in that respect.
Okay, thank you. So I want to start off, I think, with you, Olaf, because you do a lot of coaching, I guess. Should we say coaching in this space? You used to, what really intrigued me about what you did is you managed in prop desks. Me, as a former prop trader and working in a trading pitch, you get really exposed to it. And I remember seeing a lot of good traders and a lot of bad traders. A lot of traders I thought were bad were really good. Maybe you can give us some insight in what you see are some of the major, most significant qualities for good long-term traders, and maybe some anecdotes what need to be avoided from a trading, maybe a mental standpoint. You can go wherever you want with that one.
Sure, it's obviously a quite vast question, but I think awareness is definitely extremely important. So beyond the basics of obviously having a strategy and having some experience in it, when I'm working with traders, there are a few things that in terms of basics, I really remind them. Number one is to have a trading journal. I find that at the beginning, junior traders, they write everything down, but tend to forget things, or tend to forget to things down, or not write down things anymore as they become more experienced. And it's just impossible for anyone to remember what they really thought when they went into certain positions. And so having people to start to write down again in the trading journal why they go into a position, what they're really thinking about, etc., that they can go back to afterwards helps them to significantly increase their performance. The second thing I would say is really about right-sizing your bets. People tend to forget that to some extent. But most of the traders are not right more than 50% of the time. It's more than when they're really confident, they take big positions, and when they're not so confident, they take smaller positions. So when on the positions that they are taking, which are larger, they win more than 50%, and that's how they can make a significant P&L. So you have to find your own way to judge where your confidence level really is, and then right-size the bets accordingly.
I'd like to move on to Alvin with that. We've discussed earlier, I think you seem to have a good sense for what's changing here with things in China and moving offshore. And something that really struck me that you mentioned and connected dots with what Julie mentioned was access to global regulated markets. How is that changing here, and how do you think that might change the markets and investors' decisions and things here? Right.
Well, again, that's a big one. I really liked your answer actually about what traders really need to take into account. I'd like to come back to that, but maybe I'll answer your question first. I mean, about half our guys are actually trading out of China. And so the question is, when is this deluge of competition going to come, over to Hong Kong and start competing with the rest of us guys? And a lot of them are really smart. And the reality is that a lot of them are ready to come offshore, if not for capital controls and not for, certain regulatory issues that are involved. But over the long term, they will come. You look at the number of AMAC registered, hedge funds, so to speak. It's in the neighborhood of around 6,000 to 7,000, right? So these are all have had time to nurture at least a local understanding of the market, and a lot of them have made a great career in commodities trading in the CTA space. And so the great interesting thing about what's happened this year, it's actually filtered out a lot of the not poor talent, but the talent that hasn't really taken risks seriously. And the guys who have floated to the top are coming to Hong Kong. And if you look at the number of SFC applicants, a big majority of them are actually from China. And I can tell you a lot of them made very, very good returns over the last 12 months. And not all of it is on, A-share. A good chunk of it in the multi-strategy and the systematic trading is actually in the CTA space. The problem is for them that they have the edge that everyone else here has that they are still struggling with is the access to products. So to your point, in Shanghai and across several exchanges, they have maybe only about 50 of these products that they can access, right? CME alone has 250 products that you can access on the futures exchange. So this is giving us a little bit of a head start as they come offshore and they start to develop these strategies. The signature of the volatility is different from market to market, and it's something that they're going to have to wrestle with. But by and large, they are coming. And so that's what I see.
Would you want to just rope into the other question, and then we'll have Daryl follow up on that?
Yeah. So it's interesting. Olaf talks about keeping an investor journal or a trading journal. So when we advise traders who are becoming fund managers, we look at it from a business level, right? You're no longer trading for yourself, you're trading for third parties, which demands a whole new perspective. Anyone can cook a nice bowl of noodles or a good crock of chicken wings, but at the end of the day, you're not selling it to friends and family. You're selling that bowl of noodles to people who have no idea who you are. So you have to have all of the discipline in place before you do that. So the practice of keeping track of how you're behaving and a journal is actually something that few people know, is something that SFC really looks after. They want to know, are the trade rationales in place so that when they come knocking on the door and you have an investor who's challenging you, you can show them that this was in good conscience. This was a rational decision, systematic or otherwise. And that discipline needs to start on a per trade basis and not just on a thematic or strategic basis.
Daryl, you want to go with that one a little?
Yeah, I certainly agree. And discipline is the key factor. But it's also mental agility. That's the key factor in any trade. Feel free to marry your girlfriend, but don't marry your positions. The first thing, trading is about sex, S-E-X, and it starts with a stop. Not my entry point. My first decision on any trade is where's my stop? And it has to be placed logically. Now, of course, I'm using a chart basis on that and combining that with a financial basis as well. So it's stop, then it's entry, and then it's exit. And if it doesn't work, that's what the stop's for. You have to have the mental flexibility and the agility to say, I got that one wrong, out of it as quickly as possible, minimum damage to a portfolio position, on to the next trade. And unsuccessful traders, amateur traders, do not have that mental flexibility. They think that hours and hours of research is a substitute for certainty. It's not certainty. We are living in a turbulent time. We like to think we know what's going to happen next, but the reality is we probably don't. But China is interesting. I've been working China markets for 14 years, and there is a tremendous demand for technical analysis and application of charting. The reason? We all know. Fundamental news in China is manipulated, it's slow, it's unreliable, it's some good fairy stories, etc. If you can't rely on any fundamental information, then the only reliable information you've got is in the price chart. So the skill levels of Chinese traders in applying technical analysis, in developing technical analysis, is about a generation ahead of what we are in the West. We are complacent about what our skill levels are. And when Chinese traders start to come into our Western markets, once capital controls are loosened off a bit, then we're going to face competition that is quite at a level that's quite unexpected. But that also gives us an opportunity as well.
What's the time frame for that?
What, for loosening capital controls?
Well,
last time I talked to Li Keqiang, he wouldn't give me a time frame either.
It's 10 years down, keeps being...
No, sooner than that. Yeah. And I would suggest that as Trump ramps up tariffs and trade wars, that the move towards opening capital accounts, the move towards sophistication in capital markets within a BRI context becomes much faster and much stronger. That's one of the key impacts, the momentum towards opening up markets.
Well, one of the discussions I've really enjoyed with Olaf is the psychology. And these type of events really bring back someone who's born and raised in the trading pits, a lot of things you learn. Like you said, stops. The joke in the pits were when someone was messing up in life, we'd say, oh, he's trading without stops. And the joke used to be, oh, what's your goal in life? Trade at home in my underwear. And a lot of guys, I know one guy who did that and ended up doing that, and he watched one thing, a point and figure chart. Now, you might describe what that is in a little bit, but I wanted to go back to Olaf with this because we had a discussion earlier, and I always thought some of the worst traders that I've seen were the overly masculine ones. Now, that's me. And we brought up discussion, we had a discussion, well, it seems like some feminine qualities would be better to be properly measuring risk, reward, and trading. Well, if you want to go with that one there, any thoughts on what you've seen, and maybe some anecdotes with the best successful?
Sure. I mean, we had some comments about that before. The big handicap that men obviously have in terms of trading is testosterone. So we all in general want to make rational decisions, but testosterone in many situations just prevents us from actually, number one, making those rational decisions, and in some cases it even distorts the way that we see reality. So making those rational decisions in turbulent times becomes obviously quite difficult, and all the tools that you can use, they're very good, but more often than not, traders actually don't follow them for some reason. I think that is the number one. And then I think in general we all have our different personalities, which impact also the way that we trade. So number one, there's obviously quite a different type of traders and quite a lot of different strategies that you can trade. And so if you're somebody who likes to be very active, then you probably will focus more on short-term strategies. But that can then also bring the risk that when there's nothing to do, when you should just be sitting still, you just trade far too much. Whereas other people who tend to look at just the very long term and tend to be maybe at times a bit slow to adjust when there's really a regime change. So it's really important to know whether are you somebody who's more optimistic or more pessimistic generally, because it does impact how you interpret even completely rational data, and then how you enter trades after that.
Alvin, you want to? Sounds like you got.
Yeah, it's interesting you mentioned about testosterone and the feminine touch. So this year we had 2 graduates off of our platform. One was a young guy who left as an analyst and returned to his firm as a partner. Started with just $5 and then has now got a $100 million allocation. Right. The second graduate, which I can't disclose, but it's coming. It's a woman. And she was our first female portfolio manager, first female PM. And most managers on our platform stay 3 years before they get picked up by an allocator. She was on our platform for 7 months. And after just the first cap intro event that we brought her to, she got bought out. And I asked the allocator, I said, why is it? And he says, well, Alvin, right? Her performance, is actually only high single digits, right? But why is it that you picked her up? I said, well, Alvin, he said, if you look at the way how disciplined she is, she has stops every time she turns around to go to a meeting, to use the washroom, to come and talk to me, to pick up the phone. She's got stops all the time. She's disciplined, and it is about building enterprise value from the perspective of the allocator. So this is actually translating that practice into raising assets, because it does translate.
Especially once you have a team with many different kind of traders and strategies, etc., diversity is always best. And I think the world of finance, as you all know, has quite changed over the last 10, 15 years. So the pits typically don't really exist, and so some of the qualities that were probably very useful in order to be profitable in your trading strategy are much less useful now. But I still think that even the fact that there are more and more machines trading, there is usually still human decision making in that process, which basically brings the same issues that we discussed so far. So that's still all relevant.
Well, I've got Daryl, you want to comment on that one?
You go first and I'll follow.
No, you go. Sorry.
Okay. One of the biggest dangers, and I won't go in terms of women being better traders than men, there are good traders, full stop. I don't think we can do it on a gender bias one way or another. But the one thing that we all have to be aware of is confirmation bias. We see what we want to see. One of the beauties of the market, and the fact that...
I'm definitely guilty of that in some of my research.
The fact that Mike is wrong about gold is an example of this, you see. We all look at the same charts, but we all reach different conclusions. And each of those conclusions is equally valid. And we'll trade those conclusions. Which one is right, which one is profitable, that's distinct from right, that depends on where we place our stops and how disciplined we are in doing it. But here's a simple method to look at your confirmation bias. Take a chart. Let's say it's a downtrend and you think it's beginning to move to a break to an uptrend. Turn the chart upside down. If you're looking at a rising trend and you look at it and say, no, that's likely to continue moving up, your confirmation bias is bullish.
Or ask a child.
Or...
I used to do that with my kids.
That's another way to do it.
Too old now.
Children get sick of it eventually. That's one of the problems. But no, turn the chart upside down. And if you've got exactly the opposite conclusion, then you're looking at the chart objectively. But if it haven't, if the conclusion is the other way, then your confirmation bias is at play. Now, the problem is that that's a habit. I could all ask you to cross your arms as you are at the moment. Do it the other way. You can't change your habits, and that's another factor that's really important. I'm a chocoholic. I make an open admission to that. If there's a bar of chocolate in the fridge, I live in the tropics, then it's got a very limited lifespan. The only way I can avoid that temptation is not to have a bar of chocolate in the fridge. So I can't change my habits, but I can ameliorate the effect of those habits. And if we recognise our bad habits in our trading and consciously avoid them, not change them, but avoid them, then we can avoid the damage that we often do to ourselves.
So before I fire up on Daryl about his poor view on gold, I think it's best to maybe ask the audience if you want to query a few questions. And I'm happy to go there as much as possible. Let's make this extemporaneous. So we have a question. Let's bring a mic. If you have a mic, or we can just... Yeah, let's do it with the mic. It's easier if that's okay.
Let's just do a simple poll. Who's bullish on gold?
Who's going to be wrong on gold? No, but it's actually, that's the way I look at it. If gold goes down and I'm wrong, and it means the U.S. dollar is not getting beat up, and it's, some people might want it beat up, and the U.S., basically it's the U.S. stock market, volatility is not rallying from the lowest level ever, essentially in my life, that's a good thing. That's probably why a lot of people have to be allocated to some gold, because you need that diversification protection. So a question, sir. Let's go with you.
Without Mike, I haven't got a market.
Exactly. We're bid and offer. Sorry. I think, is the mic on? Or are you on with the mic over there, please, sir? Turn it on. Okay, go try now.
Two questions, please. One is about that. What is the difference between technical analysis and techno-analysis? You refer to two things. And then second question, why should there be discussion on trading journals when we have digital tools available easily?
Can you repeat the second question? When we have digital what?
Why we discussed trading journals? Because we have the digital tools easily available.
Oh, I think if you want to start, and I think you might want to go with the other, or if you want to go, let's go there.
All right, so the distinction between a technical analyst and a chartist, make it very quick and simple. A chartist is simply looking at the price activity shown on the chart. In other words, the open, high, low, close on the chart, and is not applying any manipulation of that underlying data series. Whereas in a technical analysis, we're taking the price activity, open, high, low, close, and treating that as a data series. Simplest example, we apply a moving average, so the value of the average is not actually an open, high, low, or close value. It's a calculated figure. So technical analysis becomes much more complicated than that, but it uses the price data series as a starting point. No, well, they'd be quite different because...
Let's move on to the next one. Yeah. We don't want to dwell on this.
It's a long question. Talk to me later.
Yeah, Olaf, you want to address the other one? I think you want to.
Sure. Well, regarding the trading journals, it's true that we obviously have more and more systems at our disposals to help ourselves with entry points, exit points, etc. But I think the rationale of why you want to go into a trade is typically more complex than purely the technical part, and keeping track of that precisely, keeping track of what it is that you had in mind when you entered into the trade, so that you can refer back to it at a point in the future, is still, and whether you actually write it down or you put it in a spreadsheet or you put it in some kind of system is pretty much the same. But the point is that many people just use their P&L to basically follow what's going on, and then sometimes struggle with going back and then adjusting their position according to that.
Yeah, I just want to add on top of that. Yes, there are more technical tools. Now, when we talk about CTA, we talk about trading, at least at a not just institutional, even at a family office level, you are relying on algorithms that allow you to access markets and technicalities in a sort of compartmentalized way. But let me give you a sort of a window into how allocators look at systematic traders. When we look at systematic trading systems, and we look at, say, a multi-strategy approach, which has a combination of not just multi-factor, but could be, say, a combination of mean reversion, trend following, momentum, etc., and all of these factors in place, the question always comes to, how is the allocation strategy decided at different points of what you perceive to be a market cycle or a shift in the market? Allocators will always ask that. So even if you are saying, okay, well, you know what, I don't really need to make a journal of the exact trade. If you're deploying a strategy or a tactic, you need to have a journal of that tactic, the sentiment that you feel, how you view the market, and that therein becomes your rationale. So it doesn't stop. It just gets broader. That's all it is.
I think, sir, gentlemen, why don't you go ahead?
This question is for Daryl. With the explosion of algo trading and like lots of complex strategies, your topic about watching patterns and having specific targets based on patterns, do you think these algos can sometimes be just hunting for these particular pattern-related stops, and hence the patterns automatically fail due to these algo strategies?
It's an interesting question which we haven't got the answer for yet. Let me put a couple of things to it. The patterns I'm particularly interested in are those that capture the psychological behaviour of the market. There are lots of other patterns out there, and Bukowski identifies multiple ones, but the ones I'm interested in are the psychological ones. The algo ones, we will find different edges in algo trading, and we may have to look in different parts of the market, different segments of the market, to be able to apply our techniques. Algos give us a different range of opportunities, and it's still unclear exactly how those are going to develop and where they're going to be found.
Okay, so we're getting towards the end. Any more questions? We have basically time for one more. And I wanted, if anybody has a question for Olaf or Alvin, because Daryl's presented earlier, so I want to make equal time for everybody. One more question. Sir, can we go with you? Can we bring a mic? There we go. Thank you.
Hi. Thank you for the talk. It's very useful for individual investors. I have a question about how do you fix your stop loss? We have a lot of some statistics saying that about 75% of our trades, if we can manage to get 75 of our trades, they are in profits. That means we are very good traders.
Can we ask Alvin or Olaf, do you want to address that?
Well, I mean, stop loss is a very interesting one because whenever we lose money, we typically feel the pain. So, I mean, first of all, you mentioned that you need to win on 75% of your trade. I think if you win on 75% of your trade, you're probably one of the best traders in the world. That happens very, very rarely. And as I mentioned before, even if you win on 48% of your trades, if those trades are the one that you bet the most money on, you still can make a fantastic return. So it's not that much that you have to be right all the time. It's more about the position. But stop loss is obviously extremely important because, again, once you start to lose, it becomes more and more difficult because of the pain that you're feeling to actually make a still rational position. So having those in place in order to really make sure that you do make the right position and not at the worst possible time, definitely makes sense. I know from a technical point of view in terms of how to I know what.
Well, I don't have a time because there's so many ways to actually set it. You can actually price it. The key is pricing your stops. Whether you price it for volatility, you price it for your appetite or risk, etc. And your perception of risk is actually a very introspective discussion. For individual traders, I highly recommend that you read a book. I think a lot of people have read it by Jack Schwager, actually, Trading Wizards. Hedge fund trading wizards, read them all. These are great interviews with the best managers in the world, and it walks through the life of how they started off as an individual and for some epiphany created for themselves a system of building a trading strategy. And what you'll find common amongst all the best managers is a deep respect for risk, and by that is starting with you as a person individually, and then translating that into a quantitative approach.
Okay, so Daryl, you get the last comment before we break for refreshments.
We set our stop based on a logical chart point. In other words, a support or resistance level.
What's the key thing in stops is liquidity. Got to have liquidity in futures. You provide that. So I want to, we're finishing up. I want to thank every one of you for attending and for all our participants, and most notably the CME, our sponsor. So I don't know if we're going to open up that door, but it was kind of tough starting out where you could see the bar, and now that it's closed, let's kind of convene to the refreshments. Thank you, everyone.